Hello, and welcome to this lecture on the transmission of monetary policy to the economy. In this session, we are going to summarize how monetary policy decisions spread through the economy. In the United States, the Federal Reserve adjusts monetary policy in response to changing economic conditions. Remember, the goal is maximum employment and stable prices. The most common response is raising or lowering the short-term interest rate, the federal funds rate. A change in the federal funds rate will lead to changes in other interest rates and in broader financial market conditions. In turn, those changes will then affect the spending decisions of individual households and businesses. Finally, these individual effects will aggregate to the macroeconomic scale. This should feed into economy-wide growth, employment, and inflation. Our goal is to understand how this chain of events plays out. This will improve our understanding of how monetary policy works. Let's get started. As the then Federal Reserve Governor Jeremy Stein put it in a speech in 2013, monetary policy has one important advantage, namely that it gets in all of the cracks. The one thing a commercial bank, a broker-dealer, an offshore hedge fund, and a special purpose asset-backed commercial paper vehicle have in common is that they all face the same set of market interest rates. To the extent that market rates exert an influence on risk appetite or on the incentives to engage in maturity transformation, changes in rates may reach into all corners of the market. Let's first examine the impact of monetary policy on market interest rates. The federal funds rate is an overnight interest rate. Banks can earn this interest rate if they want to. Other short-term interest rates are substitute investments. This means that other short-term interest rates should track changes in the federal funds rate. Let's compare the yield, that is the rate of return, on 3 months Treasury bills and the federal funds rate. The graph shows that the difference between the two is close to zero. This means that the yield on 3 months Treasury bills moves almost one-to-one with the federal funds rate. How about longer-term interest rates? The graph now shows you the difference between the yield on the 10-year Treasury note and the federal funds rate. You can see that there is no one-to-one relationship. More generally, the effect of a federal funds rate change on short-term interest rates will be large. However, the effect on longer-term rates will be muted. Long-term rates incorporate expectations over longer horizons. These rates respond to how people expect the federal funds rate to change in the future, not just today. For example, suppose markets believe that monetary policy is going to tighten substantially over the next several years. In this case, longer-term interest rates today could be much higher than short-term interest rates. This is one reason why forward-looking statements about future federal fund rate changes are heavily scrutinized by financial market participants. Moving on. How does a change in interest rates impact households and businesses? Let's assume that long-term interest rates are declining because of an easing of monetary policy. This will make it cheaper for firms to take out loans and invest. Similarly, consumer loans and mortgages become cheaper. This stimulates spending on durable goods such as appliances as well as home ownership. Lower longer-term interest rates will also make yields on US dollar assets less attractive to international investors. These investors may reduce their demand for dollar-denominated assets, lowering the value of the dollar. A weaker dollar tends to boost US exports as US goods become cheaper abroad. At the same time, imported goods become more expensive, giving US consumers and firms an incentive to purchase domestically produced goods. Let's put all these pieces together. We have effects for businesses and effects for households. Longer-term interest rate changes also affect stock prices. Usually, we think about the market value of a firm as the discounted value of all future dividends. When longer-term interest rates decrease, the discount rate for future dividends becomes more favorable. This increases the market value of a firm and therefore its stock price. This increase in stock prices increases personal wealth, which further increases consumption. The belief is that stimulating the economy with lower interest rates will lead to lower unemployment. This will also lead to higher prices according to the Phillips curve. That's the theory. Let's now see how these effects play out in the data. We will examine a surprise increase in the federal funds rate. We want to know what happens to industrial production, the money supply, the unemployment rate, and inflation. The charts we will see are based on time series statistical analysis estimated on monthly data. We will measure the effects over a 2-year time horizon. The first graph shows you what happens to the federal funds rate after a one-time surprise increase of 50 basis points. Notice that the interest rate is likely to further increase in the short run. However, over time, the effect of the interest rate surprise wears off and we revert back to where we began. Here is the M2 money supply. The Federal Reserve implements federal fund rate increases with open market operations. Remember that an open market operation involves the Fed selling securities and receiving cash in form of bank reserves in return. Reserves are part of the money supply, here measured with M2. So, increasing the federal funds rate causes the money supply to shrink. It takes about 2 years for this effect to subside. Here's industrial production. The graph shows that it takes about 6 months for industrial production to go down. This is an important point. Monetary policy affects the economy with a lag. This happens for at least 2 reasons. First, firms may have already received funding for investment plans and are still implementing them. Second, it may take some time until changes in the interest rate affect consumer spending. Unemployment is the mirror image of industrial production. It takes a couple of months, but with industrial production declining, the unemployment rate starts to rise. In addition, there is evidence that inflation goes down when the federal funds rate is raised. So, if the central bank increases the federal funds rate because it is concerned about the economy running hot, then over the medium run, unemployment will increase and inflation will come down. Let's wrap up. In this class, we have summarized how monetary policy transmits to financial markets and the real economy. On aggregate level, we described how monetary policy should affect short and longer term interest rates, exchange rates, stock prices, and eventually consumption and investment. Then we looked at empirical evidence confirming that after a surprise increase in the federal funds rate, the money supply falls immediately, and then industrial production goes down, unemployment increases, and inflation declines. These effects take time to appear, indicating that monetary policy affects the economy with a time lag.